What's up, friends? Nice to see you again. This is the Lincoln Lawyer, and today we're going to chat a little bit about crowdfunding. So we've discussed a whole bunch of different scams on this channel, crypto to legal, etc., and crowdfunding is going to be one of them. All right, so crowdfunding basically is as old as any kind of fundraising. It's nothing particularly special. It's where a bunch of people get together and they fund a business or a project. But crowdfunding was actually codified and regulated in 2012 under the Jobs Act. It basically permits the raising of just a little bit over $1 million by a startup, and pretty much anybody can contribute. Don't have to be accredited. But there are limits as to like a percentage of one's annual wages. If it's below 170K, you can only contribute a certain amount, around 2,200. If it's above 100K, then it's a different amount. So that's the limitation there. And basically, that's about it. You have to go through an intermediary, all right? So the intermediary platform has to be a licensed broker-dealer. So they are the only ones permitted to make offerings under the Reg CF, which is the crowdfunding reg under Title III. All right, so that's pretty much it. I'm not going to get into the details of the law. You can read that for yourself. It's pretty basic. So about $40 billion has been raised for startups since 2012, since it's been passed. So and it keeps growing every year. It's like $15 billion a year now. And so that's it. That's going to be the factual items. Now, we are very familiar with all the scams that have occurred with respect to the IPO market, the public offering stuff, like the New York Stock Exchange, NASDAQ, and everybody knows about all that crap. Basically, that's a very, very highly regulated market. The SEC vets all those offerings. They audit, third-party independent audits. They have massive institutions as underwriters that, Chase, Goldman, etc. And so there's plenty of big business in them. But when they make the offering, I'm sure most people understand that the money's already been made for the most part. All right, this is the lockup has expired, and the insiders, the early seed venture capital investors, they're dumping their shares. The lockup is over, and they're dumping their stuff. They're making their money. And so that's a sure thing. They're not going to ride that public, the dumb money roller coaster. The retail investors generally call it dumb money. So, that's just how it works. Basically, it's a legalized form of scammery. So, I'm sure most people are aware that are watching this. So basically, there's still money to be made occasionally in IPOs. If there's enough public interest that comes in, or if there's institutions that come in and pump it up, then in order to dump it later, then there's some money to be made if you get out at the right time. So it's not everything, but obviously stuff like Peloton, Uber, Lyft, they've never made any money and they're still going IPO. It's ridiculous. It's absolutely, I'm not talking about their scams. They're legal scams. They are scams, but they have a business. They have a legitimate business. They have profits. They don't have profits. They have revenues. They have revenues, no profits. They're pretty much losing hundreds of millions a year. So, but they're still allowed to go public and raise additional money from the retail investor. There's no checks on who invests, who buys those shares. So, if that particular market is so rife with fraud and scammery, legalized scammery, crowdfunding is 10 times worse. I've gone into crypto, stuff like that. Crypto is terrible, so it's extremely, extremely super risky. Crowdfunding is pretty much up there also. It's really not something that I recommend for the average investor to get into. I don't think any financial advisor, financial manager would recommend getting into crowdfunding as an investment vehicle. It's super, super, super high risk of loss. Okay, so, do you seriously expect to put in a couple of $100, maybe $1,000, whatever the investment is, and or $2,000, whatever, and then receive, a 10x, 20x growth as far as if you're doing equity? Or if you give up a couple of $100, you get a product that's, 5-10 times less than it's going to be at retail, and it's going to be a high quality product. Seriously. Just think for yourself. If I mean, you're going to put in the money and you're going to get a return on that money, the chances of that are, lightning. All right, so there's a couple of kinds of different types of crowdfunding options for most people. Generally, there's donation based, so that's pretty much you're giving the money away. All right, you're just giving them money. It's like charity. All right, so you don't expect anything, you don't get anything. So it's a project you really believe in, green, whatever it is, solar. So whatever, that's one thing. That's probably the safest one. I mean, that's where you're losing your money. You don't expect anything, so that's fine. Then there's rewards based. That's where you're supposed to get a product or pretty much anything. You can get anything, a product or a card, a thank you card. Maybe it's an option to buy a product in the future at retail or below retail, whatever it can be. And then there's equity based crowdfunding, where you get an interest percentage of the company that is offering the project. So then you get the proportional amount of income, revenues, dividends, etc. going forward, if any. All right, so that's pretty much the three kinds. Mainly going to focus on rewards and equity here. Okay, so going into this, basically you need to understand that there's a conflict of interest. All right, initially getting into this, there's a major conflict of interest between these platforms, these intermediary broker dealers, and the investor. All right, you need to understand this. So unless a project hits its goal, unless it's fully funded, then the intermediary gets paid nothing. All right, the funds are refunded, they go back. So why would they want that? They want to make money. All right, so they want to hit that goal, and they want to hit that goal, keep hitting it as much as possible. All right, so they can take their commission, 5%, 10%, whatever it is. Some take more. All right, there's plenty of these intermediaries. There's tons of them, mainly Kickstarter, Indiegogo, stuff like that. There's other ones. The security ones, they have to comply with SEC regs. There has to be some filing with SEC, some disclosures. Those are securities. The rewards based is governed by the FTC pretty much, which concerns consumer safety. In case of fraud, they can halt that kind of stuff. So basically, conflict of interest. The platforms want these things funded as much as possible to make their commissions. So it's as simple as that. All right, it's a similar situation to crypto exchanges where they need those funds flowing, churning through, coming through. So they make their commissions on the exchanges. It doesn't matter, whether the token is successful. It doesn't matter to the broker dealers if a startup is successful. It's funded, they get their commission, and they forward the money. That's it. That's their whole game. All right. So you need to understand that that's a conflict of interest. Basically, I believe that there should be a flat fee paid by each startup. You pay a flat fee, you make your offering, all right, and then there's no interest, there's no conflict there with the platform. All right, they already got paid. Okay, so let's say if it doesn't fund fully, it doesn't hit the goal, then the funds are refunded, and then potentially the startup can get some funds back. They can get some of their money back. Okay, or they don't get any money back. And if it's fully funded and they get their funds, then the platform will get a bonus, an extra payment from the startup. Okay? So that's kind of some options potentially that I think would be much better than commission based on, the hitting the goal as frequently as possible. So then you shift the responsibility on the startup to pay the fee. And if the goal is met, pay an extra fee. So there's, a little bit more, whatever, it's 10%, 20%, doesn't matter. So, that eliminates that conflict of interest. That puts the onus on the startup. And if they don't have the money, then they shouldn't be making the offering. It's as simple as that. All right. So what can I say? The startup should be liable. So the other issue is a complete lack of due diligence by the intermediary platform. Okay, so that's a major problem. Basically, they completely disclaim all liability to investors, which is nuts. So they're like, there's no responsibility to investors. They should at least be held liable for gross negligence. Okay, it's an absurdity that they can be allowed to disclaim all liability no matter what happens for fraud, any kind of lack of the most basic diligence. So that's a big problem. Okay, that should not be permitted. They should have some liability. I don't know about negligence, but definitely for gross negligence. I mean, I don't think there's any question about that. Okay, so, the other issue is a complete lack of due diligence by the intermediary platform. Okay, so that's a major problem. Basically, they completely disclaim all liability to investors, which is nuts. So they're like, there's no responsibility to investors. They should at least be held liable for gross negligence. Okay, it's an absurdity that they can be allowed to disclaim all liability no matter what happens for fraud, any kind of lack of the most basic diligence. So that's a big problem. Okay, that should not be permitted. They should have some liability. I don't know about negligence, but definitely for gross negligence. I mean, I don't think there's any question about that. Okay, so That's one thing. They disclaim the liability, all right, which is unfair. They should still be, liable. Next thing is there's complete and total lack of due diligence conducted by these platforms, which is nuts. So at the very least, the offering startup projects need to have a U.S. company, and I've seen non-U.S. companies permitted on these platforms. It's like, they don't even care at all. I mean, it doesn't matter. They just want a social security number, and they'll let anybody on there. I mean, whatever. So that's unacceptable. Okay, so they need to verify this company. They need to verify the valid existence of this company. All right, they need to validate all the founders, all the owners, the beneficial owners, everybody who owns the company, everybody who's working on the project. All right, they need to validate their identification. They need to have their names, in my opinion. All right, they need to also validate the project, the stage of the project is in. So they need to make sure that all statements made by the project development team in their marketing materials on their offering page are true. They do need to confirm that. I mean, if they don't want to, well, shit, sorry, dude. They need to, they get the fee, all right? They should get that fee, the flat fee that I just mentioned, and they should use that fee to conduct some diligence on the project. They should, if a project is ready for mass manufacture, if it's ready for beta testing, for alpha testing, whatever, they should confirm that. They should get a shipment of the project and make sure that it works, that it's there, that it at least exists. There's something there. They should review company documents, company agreements, that the company validly exists, that it's conducting some kind of work, that it's, that it's doing the actual development of the project. Okay, so they need to make sure that they're vendors, contracts with vendors. They need to verify that. They need to verify that there's contracts with the founders, that, they're getting salaries, whatever is going on there with the funds. How are the funds going to be used? I mean, they do none of this. That's a big problem. They don't require any CPA audits. There's no CPA requirements, no financial statement requirements, nothing. I mean, it's nuts. So, the most important thing is they need to verify the founders and the stage of the project. I mean, if there's no project, okay, fine, just verify where they got their startup money. I mean, are they bootstrapping? Do they have a product? Have they made any sales? I mean, is the thing, what stage is the development in, or is it like a drawing? Is all they have a drawing? Then that's all they can say in their marketing, in their offering page. That's all. We have a drawing. That's it. They can't say we have a finished product. All right, they need to make sure that that's how it works, because it doesn't. I've seen all kinds of marketing shit on offering pages, like they have, they're ready for mass production. That's what they say, and they don't even have a product. They don't even have a beta, alpha tested product. They have nothing. They don't have any software. They have no contracts with developers. All they do is marketing. That's it. They have a marketing budget. Totally unacceptable. All right, so they should get a fee, whatever, 5, 10, 15K. Let's say you grade the fee on the stage of the project. If it's total startup, there's nothing there, 5K to list on the broker-dealer platform. Let's say it's alpha beta testing, 10K, and if it's a finished product, 15K. I don't know, whatever. Just, suggestions, all right? So that's hypothetical, all right? So they need to do some diligence, which they don't. It's scary, all right? It's scary, but it's a fact. You need to be aware of that, all right? Nobody is going to do your due diligence. That's your job, all right? Which is pretty much impossible in many cases. My opinion, these offering broker-dealers should take a role similar to the SEC, all right? That is what they do in IPOs, and not a super job at that. They miss a lot of shit. Companies can fudge their numbers. They can't catch everything, all right? So these broker-dealers need to have CPAs, and they need to scan their financial statements. They need to review the actual project, what stage it's in, and they need to verify it, so they hold some liability for the offering. That's just how it should be, all right? If they can't do that, then they need to be regulated. There need to be a regulator that does that whom they pay a fee to do that for them, or maybe an outside party, an outside government-sponsored, sanctioned, regulatory agencies, quasi-regulatory agency, quasi-private, like FINRA, something like that, like a mixture. There needs to be someone who does diligence on these crappy bullshit offerings, okay? Because as I've said, similarly to the token offerings, all right, ITOs, whatever they freaking call them now, nobody vets them. Nobody vets these projects. Nobody vets these people. There's no background checks. They could be scammers from 2, 3, 4 different projects ago, and now they're back. They got another one great marketing materials, shiny, you know, beautiful new token that's going to take over the world. Just, you know, buy some tokens. There's the offering page. Nobody reviews that shit, you know. So that's a big problem, all right, the diligence aspect of it. Finally, I do strongly suggest that the regulations include a requirement for these startups to obtain legal and financial, you know, tax counsel. It's like CPAs, whatever, a tax professional. They should at least have that at the very least, because I've seen a mess, just absolute mess of documents. All right, legal documents, financial documents. They need to have at least these two parties handling that stuff, because they have ethical obligations for honesty, generally speaking, you know, not always, but at least greater than, you know, non-professionals that are not unlicensed, that don't owe any obligations to the bar, so to speak, or whatever regulatory authority they have. So I think they should be required to at least obtain counsel, to oversee the offering, to oversee, control the language, to make sure the language is acceptable, the marketing stuff. It can be puffery, okay, it can be opinion, but if you make statements of fact and it's untrue, then that would be unacceptable, and a lawyer can really assist with that, and drafting all the offering documents, disclosures, risk disclosures, and you know, that's pretty much it. And then the CPA would be able to do the financials, submit them to the platform for review. I mean, I think audited financials should be required at least annually from these startups. There's got to be more control. So generally speaking, the current stats are like, well, 10% of them are outright scams where there's no product, money's gone, boom, sayonara, all right? And a much larger percentage than that, it could be a majority, where the project is you know, substandard, where the product that is received is bullshit, it's substandard, and it's low quality. It's not ready for retail, which is pretty much what I'd expect. I mean, you can't expect to develop a retail ready product from $1 million, zero to retail. That's impossible. I mean, you know, it has been done. There's only a few companies that have really used the crowdfunding seed capital to grow into multi-million-dollar successful, profitable companies. There's very few. Really, you know, Kickstarter has done hundreds and hundreds. They can list maybe 5 or 10, all right, that have grown big. So, you know, they can say whatever, crowdfunding, yeah, okay, it's amazing. You know, it has potential. All right, it has potential to create disruptors. It's certainly possible, but it needs to be regulated and vetted to a much higher degree. That's all I can say about that. So pretty much I'm going to end it there. As I said, basically, you need to conduct your own diligence. Nobody's going to do it for you. Nobody gives a fuck about your money. Like, if you lose your $2,000, what are you going to do? You're going to get a lawyer? You're going to sue? I mean, you know, what are the chances of that? Next to nil. Next to nothing. All right? And the chances that FTC or SEC takes regulatory action, very small, unless it's a very large amount that's lost, that's stolen. It's clear fraud. Money has been clearly misappropriated. Like, the founders are buying, you know, Ferraris and houses, and, you know, they've, you know, whatever. And so there's no project, and they're just bullshitting the investors. Maybe then they'll act. It's a couple of $1 million. They can act, maybe. But if it's maybe under $1 million, chances are it's gone. I mean, lawyers aren't going to bother. The government isn't going to bother. So you just need to be aware of that. You need to do diligence on the founders, on the company, request governing documents, vendor agreements, you know, and you need a lawyer to do this diligence. You know, what can I tell you? Nobody's going to hire a lawyer for $1,000, $2,000 investment. So that's what they're counting on, but it's unlikely most people can do their own diligence on these companies, because you really need a professional. You need to review these documents. I've seen documents forged, all right, fake ass company documents, you know, so, and you really need to understand how to spot them. So there's, you know, I can't explain it here. So, you know, you're on your own, basically. You're on your own with crowdfunding, on your own. Just, if you're investing, if you're putting funds in, expect to lose them, all right? That's it. That's all I can say. Expect to lose them, period. Thanks for watching. Stay safe. Sayonara.